Hey there. Today, we're diving into something you might have heard about in the trading world, futures contracts. They sound fancy, maybe a little mysterious, but they're actually a cool tool once you get the gist. This is your guide to how futures work, what they do for commodities and indices, and why traders use them. By the end, you'll see how these contracts shape markets, from oil to stock indexes, and why they're a big deal. No prior knowledge needed. Let's break it down together. How futures contracts work. So, what's a futures contract? At its heart, it's an agreement to buy or sell something at a set price, on a set date in the future. Think of it like pre-ordering a pizza. You lock in the price now, but you get it later. Except here, it's not pizza. It's stuff like oil, wheat, gold, or even a stock index. And you're not always planning to take delivery. More on that in a sec. Here's how it goes. Imagine you're a trader, and you think the price of crude oil, sitting at $70 a barrel today, is going up. You buy a futures contract, agreeing to buy 1,000 barrels at $70 3 months from now. If oil hits $80 by then, you've scored. You can buy at $70 and sell at $80, pocketing $10,000 profit minus fees. If it drops to $60 though, you're stuck buying at $70. Ouch, a $10,000 loss. That's the basic idea. Lock in a price now, settle later. But here's the twist. Most futures traders don't actually want the stuff. You're not getting 1,000 barrels of oil dumped in your driveway. Instead, you can sell the contract before the delivery date, called the expiration, and cash out the difference. It's all about betting on price moves. Futures are traded on exchanges like the Chicago Mercantile Exchange or Bradbury, CME, where buyers and sellers match up. Each contract's standardized, same size, same rules, so it's easy to jump in. One more thing, futures use leverage. You don't pay the full value up front, just a deposit, called margin, maybe 5 to 10% of the contract. For that $70,000 oil deal, you might only put down $5,000. If the price moves your way, your profit's huge compared to your stake. But if it goes against you, losses pile up fast. Leverage is why futures feel like a roller coaster. High reward, high risk. Their role in commodities and indices. Now, let's zoom out. What do futures do for commodities and indices? First, commodities. These are raw materials, like oil, corn, coffee, or gold, that keep the world running. Futures started here, way back with farmers. Picture a wheat farmer in 1800s Kansas. He plants in spring, harvests in fall, but doesn't know what wheat will sell for then. A buyer, like a bread company, offers $5 a bushel now for delivery in 6 months. They sign a futures contract and both lock in certainty. The farmer knows his profit, the baker knows her costs. That's the roots of futures, managing price risk. Today, commodities futures are massive. Oil futures like West Texas Intermediate or WTI, traded on the CME, set global oil prices. If you hear oil's at $75 a barrel, that's often the futures price. Same goes for gold, silver, soybeans, you name it. Traders bet on these prices, but producers and buyers, like farmers or airlines, use futures to hedge. An airline might buy oil futures to lock in jet fuel costs. If oil spikes, they're covered. If it drops, they lose a bit, but avoid a crisis. Then there's indices. Think stock market benchmarks like the S&P 500 or Dow Jones. Futures here don't deliver wheat or oil. They're tied to the index's value. An S&P 500 futures contract lets you bet on where the market's headed. Say it's at 4,000 points now, and you buy a futures contract at 4,050 for next month. If the S&P hits 4,100, you profit off that rise. Each point's worth $50, so that's $2,500. These contracts are cash settled, no physical delivery, just money changing hands. Investors use them to speculate or hedge against market swings, like a shield for a stock portfolio. Why traders use futures? So why do traders love futures? 3 big reasons: speculation, hedging, and leverage. First, speculation. Futures let you bet on price moves with less cash up front than buying the actual asset. Want to play oil prices? A futures contract costs way less than 1,000 barrels of crude. Same with stocks. S&P futures are cheaper than buying all 500 companies. If you're right, the leverage multiplies your gains. A $5,000 margin turning into $10,000 profit? That's a 100% return, way more than a stock might do. Of course, losses can wipe you out just as fast. Second, hedging. This is about protection. That airline locking in oil prices, they're hedging against a spike. A farmer selling wheat futures hedges against a price drop. Even stock traders use S&P futures to guard against a market crash. It's like insurance. You pay a bit now to avoid a disaster later. Businesses love this. It keeps their budget steady. Third, leverage again. It's a double-edged sword. That small margin controls a big position, so small price moves mean big bucks. Traders crave that juice, especially pros like hedge funds. Plus, futures market run nearly 24/7, unlike stocks, so you can react to news anytime. But it's not all rosy. Futures are complex, volatile, and not for the faint-hearted. You need a plan and some guts. Closing, and there you have it. Futures Contracts 101. Quick recap. Futures are deals to buy or sell at a set price later, used for commodities like oil and indices like the S&P 500. Traders use them to speculate, hedge, or leverage their bets. They're a powerhouse in markets, setting prices and managing risk, but they're a wild ride. Want to try? Start with paper trading to test the waters. Real money can wait. What do you think? Futures sound like your thing. Thanks for sticking with me. See you next time.